My name is Wesley Boudreaux, one of the financial advisors here at the Retirement Group. Today we're going to talk about our Retiring on Purpose with Purpose webinar, but going to correlate it a little bit more to the oil industry. Do a lot of work with some of the big names and small names in the industry and help those individuals retire. So we'll talk about some of the different things you're going to see from time to time, how it affects your pension and what that retirement process actually looks like, and some things to be aware of. Before I get started, I just want to remind everybody the Retirement Group we are not affiliated with nor employed by your specific company, even though we have worked with a lot of them for upwards of 30 years or so. Now, throughout the course of this webinar, there's a couple of things to be aware of. There is a chat box. So go ahead and keep an eye on that. We'll be putting some information in there periodically, different items like how to follow along with us on LinkedIn or how to schedule an appointment with myself or one of the other advisors across America. We may put a survey in there to ask us how we're doing or any updated topics you want to see for these webinars as well. There is a Q&A box. So if you have any questions, feel free to put your information in there as well. It is anonymous, so your name will not be shown. I'll try to get to as many of those as I can at the end of the webinar. If we don't get to that, I will be sure to try and follow up with you as well. So again, let's kind of get into it. For those of you who do not know who the Retirement Group is, again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. Like I said, we've been doing this for about 30 years, and for a lot of that time, we've been working with some of the bigger oil companies out there. And we've worked with quite a few, so we have a great understanding of your benefits plans, usually inside and out, whether it be the pension, the 401k, healthcare, retirement, medical, life insurance, all those different things that you have questions about as you transition to retirement, whether it's a couple weeks away or a couple years away or 10 years away even, if you want to make sure you're planning appropriately. We do offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can still accommodate that, but obviously this day and age, some of the easiest things to do is going to be web meetings, phone calls, emails, all that's available to you as well. And if you take us up on anything, and you haven't done so yet or it's been a while, is to run our complimentary cash flow analysis. This is really the best way to see if you're on the right track to retire when you want to retire, whether that be, again, in a year or whether you're trying to compare, okay, should I retire now or work a couple more years? We'll go through all that whole process with you and tell you financially whether you can retire or not. We're not going to shy away from, unfortunately, telling you, hey, you need to work another 2 or 3 years or something like that. But we'll also uncover some of the different benefits you may not be aware of to tell you you might be better off retiring, a quarter or two sooner in order to capture more benefits from the company. So again, a lot of those items go into it. Let's talk about that transition process and what we've talked about for years as far as our comfort checklist to make sure you have a sound transition into retirement. So first and foremost, you need to be comfortable with the decision and comfortable with your emotions, and that can go through a couple different ways. First and foremost is the decision to retire. You need to run a cash flow analysis, understand the finances, and be comfortable with your decision as far as that you've saved enough and you're prepared and ready for retirement. And you need to have those emotions in control too. A lot of times we have conversations with individuals that say, I'm retiring at 60 because that's when I want to do it, or I'm retiring when my son graduates college, or when I hit 35 years or 40 years with the company in some cases. Now, those are good emotional ties, but in reality, in some cases, it may be beneficial to leave a little bit later or earlier, and it will be better for you financially. So we need to go through those with you. You also need to be comfortable with that investment strategy. So that's where it goes back into that cash flow analysis, understanding what you're doing, why you're doing it, and having a good feel for what those next steps are going to be, which in turn can make you comfortable for that retirement decision. And once you are retired, on the investment management, whether you're doing it your own or working with a retirement group, then you need to be comfortable with that decision too, so you stay the course. And by doing that's going to help you also decrease your risk and volatility. That's one of the things that Retirement Group will help focus on for you if you're going to be working with us in retirement. Is ultimately it's there's worst case is running into a severe market correction and you're taking money, so you want to focus on reducing that risk and volatility, and we can do that through a number of different ways. But again, as far as understanding your risk tolerance, understanding and compartmentalizing what you're trying to achieve, and then structure portfolios specifically to meet those goals with as low risk as possible. And we're not a cookie cutter firm, so we go through multiple strategies as to how to do that and help you pick the right one. And at the end of the day, you want to increase your retirement income. So like I said before, by helping you before you retire, we can help you uncover whether or not there's any additional benefits to grab from the company. So that will obviously increase your nest egg, which can increase your retirement income. And then with investment management, our goal is to obviously help you increase your retirement income and decrease that risk and volatility that we mentioned before. And one of the ways to actually also increase that income is for you to keep it. So we want to help you focus on reducing taxes and penalties as much as possible and keep more of that money versus paying Uncle Sam for it. And by kind of going through all this is something, again, you can do on your own, but obviously we suggest working with a firm, especially like the retirement group. You can actually put this plan together and be very comfortable with your transition and focus on retirement as opposed to a second job of managing your assets. So a couple of things we're going to talk about today. We're going to look at understanding your pension, which again is going to differ from company to company here in the oil industry. We'll talk about how real estate's kind of changed and there's an impact on retirement for some of you. We'll talk about inflation, which is a big one, obviously, and then how to avoid some different mistakes in that transition process, and especially by working with an investment management team like the retirement group. So as you actually transition, there's really kind of that old school three-legged stool, but we're going to say maybe four-legged for some of you as far as where you could get your income in retirement. Now, first and foremost, obviously, we'll focus on Social Security, where you have that option to take that anywhere between age 62 or deferring out to age 70. Now, we can run a full Social Security analysis for you, and especially if you're married, there's a lot of different choices to be had, whether you look at taking it as early as 62, whether you defer to full retirement age, 66 and change, or 67, or defer even farther to age 70, where you get guaranteed increases. All that plays into longevity issues and your need for income in retirement as well. Now, most of the companies we work with, especially in the oil industry, are also going to have a 401k plan and a pension. How that pension is treated is different from company to company, but for 401k plans, it's a defined contribution plan, which case you and for most cases, the company is going to make some contributions to that 401k. Then based upon your investment selections is what's going to generate how much it's going to return and what that amount's going to be at retirement. Then from there, you can take withdrawals, keep it in the 401k, roll it over to an IRA for more flexibility, different things like that. The pensions, again, are going to be guaranteed income for the rest of your life. In some cases, we'll talk about this in a moment. Some of the companies do only have the pension as an annuity. Some give you the lump sum option, and the way they calculate that is different from case to case. And then real estate could be an option for some of you, whether you have rental income that's coming in or whether you're looking to potentially downsize and move to a different state. You could generate some additional assets out of there, which could be used for retirement as well. We'll talk a little bit about that in a moment. So the first one we talked about was understanding your pension. And let me kind of go into how interest rates can affect that pension, because a lot of you have seen, if you're monitoring your lump sum, a severe drop over the last year or so. And again, every company is different the way they calculate those, and I'll go through some of those options. But what's going to happen is, generally speaking, when interest rates go up, you're going to see your lump sum come down, and vice versa. When interest rates go down, you'll see it come up. That's if you're focused on the classic defined benefit plan. Cash balance plan doesn't operate that way. It's going to grow slowly over time, because what's happening is, just like your 401k, the company's putting in a contribution, and that's growing. It's not going to fluctuate. But the way a classic defined benefit plan works is there's a formula that's going to look at your years of service, final average pay, a multiplier, Social Security offset to determine what your single life annuity is going to be for the rest of your life. Now let's assume that single life annuity is going to be $2,500. Now usually you have that option of $2,500 a month for the rest of your life. Maybe if you're married, you want to do a joint survivor, you can do that for a little bit less and have a payout through both your lives. Or you might want to take a lump sum if the company offers it. So the lump sum, what they do is they take a look at your age, longevity tables to figure out how many more years they're on the hook to potentially pay you, and look at the current interest rates to calculate a net present value. So if they look at that $2,500 and they go out there and say, okay, well, this person's going to live for another 20 years, let's run that calculation based upon interest rates. It's going to generate X, Y, Z for a lump sum. Now, if those interest rates are low, they give you more money for you to essentially go out there and recreate that paycheck. If the interest rates are higher, they don't have to give you quite as much, and so that's what we're seeing right now. And so let's kind of talk about how those rates have moved over this last year or so. So we always talked about it. We knew that interest rates were going to come up because they were, let's face it, artificially low thanks to the pandemic. The government drove them down quite a bit, and we'll look at that on a slide in a moment. So we knew they were going to come back. Now, did we think they were going to come back this quickly and this high? No. But if we take a look at this chart right here, you can see what's happened over the last year or so. And we got this broken up between segments. Now, not every single company uses the segments, but pretty much all of them use them for a portion of their pension lump sum calculation, and most of them use them for the bulk of it. And what that is those are different interest rates they use to calculate that net present value, but there's three different segments. There's the first, second, and third. The first segment correlates to the first 5 years of retirement. Second segment is for years 6 through 20. And the third segment is for years 21 and beyond. So for most of us, that second segment is going to have the highest weighting because it covers 15 years of retirement. So let's take a look at that second column of numbers. We look at that very top right now. We're in October as far as the interest rates. We're not in October, but October is the most recent interest rates we had as the time of this webinar, because the Fed does not release those until about 3 weeks after the month, so we won't have the November rates until around Christmas or so. When we look at that right now, that second segment, or let's go across the board. October, it's 5.1%, 5.83%, and 5.68%. But let's focus on that middle segment, that 5.83. Go down that column all the way to the bottom. At January was at 3.02. So what's that, about 2.8% change. Now, ultimately, whenever we have a 1% change or so in interest rates, it equates to roughly about an 8 to 12% change in your pension lump sum calculation, depending upon your age. So let's just say, quick rule of thumb, 1% equals 10%. So that's a 2.8% change we're seeing there, which is about a 28% potential drop we're seeing from lump sums that happened over the course of the year. Now, some companies, it's updated once per year, some's monthly, some's quarterly. We'll talk about that in just a moment, how that can affect you as well. But ultimately, the issue is those interest rates have been skyrocketing. You can see them here in this chart going back to 2008 when the PPA segment rates were introduced. If you go back and let's take a look at that, again, that red is going to be that second series. You see the blue is going to have more fluctuations because the short-term rates are updated by the Fed more. But that middle segment is going to have the highest weighting for your pension. If you see the very beginning in 2008, it spiked up, got over that 8%. And then obviously we know what happened in 2008. The interest rates started coming down to kind of fuel the economy and the rebound. And so you saw those coming down slightly, but it wasn't really until about 2020, towards the end, where we saw those rates go down quite a bit, based upon the pandemic driving the rates down to try and fuel that economy. So we're coming off of the lowest rates we've ever seen in history, which equates to the highest lump sums we've seen in the history of all these plans as well. But on the flip side, you see that spike at the very end, shooting up. We're getting close to the original starting points we had back in 2008, just over the course of 1 year. So if those rates continue driving down lump sums, our thoughts are eventually we'll see those kind of level off and then maybe come back down a bit, but by no means will we get back to where we were the last 2 years with those low interest rates from the pandemic. So what are the options you have for your pension? For most of you, it's going to be either a classic formula or a cash balance plan. Some companies, it may be a combination because they change those, and it depends upon not just the company you're at, but even when you were hired, or maybe if you were part of a subsidiary that got bought out or something like that. So let's go over that again. I mentioned that classic defined benefit plan is going to be a formula where you're going to look at your years of service, your final average pay, and a multiplier they use depending upon the company. And they have a Social Security offset. They claw back your Social Security as far as what the company's been putting in over time. So that's another thing to remember. If you have not worked with the oil company for your entire career, maybe you were a teacher or doing something in the public sector, then your Social Security offset calculation might be an error, might be wrong. So they might be reducing your pension. So if you think that's something, give us a call. We can run the numbers and see if there's a reduction to yours that's maybe more than what it should be, and we can help you submit your Social Security form so that you can actually get an increase in your pension, whether it be the lump sum or the annuity. So again, that formula generates that annuity, that $2,500 a month, for example, I said before. And then if you want to turn that into a lump sum, you can by using those interest rates that they do. And again, that's going to change over time. The annuity is not going to change. It's going to grow with you over time, unless it's a frozen plan. And then the cash balance plan, that's a lot of these are newer over the last decade or so, where again, what's happening is with that defined benefit plan where there's a calculation or a formula to determine what to give you. Well, it's kind of unknown, and it's unknown how long somebody's going to live. So it's kind of hard for companies to really maintain those on their books from an accounting standpoint. So they switched over to a cash balance plan where they know what it's costing them year by year. They may give you a 6% or a 9% contribution. It may be based upon how old you are, how long you've been at the company. And once they pay that, they know it's gone. They don't have to worry about accounting for it anymore. So they put that, let's say, 6% in. Then it grows based upon Treasury rates usually. And of course, those haven't been very high for the last decade or so. But now it looks like we're getting some growth in there again. Now, also depending upon your age. There's age penalties from company to company. Some companies will allow you to take your pension as soon as 50 or as soon as 55 or 60, or some not until 65. And then depending upon how old you are, there could be a reduction. For most of the companies we work with, that 60 is kind of that 100% level. There's some where you have to wait till 65. But let's say if you retired, let's say at 57, and decide to take your pension. For a lot of the companies, there's like a 4 or 5% per year reduction. So let's say 5%. So what that would mean is if you decide to do that, you would actually get 85% of your pension because you're retiring 3 years early. Now, most of the companies as well give you the option to not necessarily take it if you don't want to just yet. Let's say you retire at 57 and go do another job for fun and you don't need the money, you can defer it till 60, so you get 100% at that point in time. Or maybe we're monitoring interest rates and those interest rates are actually coming down, so we're going to drive up your lump sum in addition to aging out of those penalties. So those are some things to be aware of as well. And just give us a call. We'll go through your individual company and how those penalties could affect you. And then, like I said before, depending upon the company, there's lump sum versus annuity options. A few of the companies, they do only have an annuity option, so it is what it is. But most of the companies we do work with give you the choice of the lump sum or annuity. Only one or two give you an option of a split where you can actually split you can have maybe 50-50 or 75-25 between a lump sum and annuity. But for a lot of those that don't, what we're looking at, if you need that income or need some protection, need some an annuity for a portion of your assets on top of what Social Security is providing, then you can look at buying your own annuity. And those rates have gone up quite a bit, where they're very comparable and in some cases better than the pension plans are right now. But we need to run those numbers side by side to show you those choices closer to retirement. So let's talk about the payment options. I really kind of just went over this: lump sum, annuity options, where you get that payment for the rest of your life. You can add a period certain in some cases where, God forbid, you retire, you get that $2,500 a month we talked about, and you get hit by a bus in the 7th year. You want to make sure something's still paid out, so you can add a period certain for 10, 15, 20 years in most cases. You can do a joint survivor if you or to cover your significant other for his or her life as well. That's going to be a reduction. It's not going to get $2,500. It's going to be less because, again, they're paying out over 2 lives. And there's some companies that have kind of a unique feature where they have like a Social Security pop-up where you get more before Social Security starts and then it drops. So that's kind of a uniform income. But again, we'll go over all these for you specifically. You can look at some of our other webinars, company-specific webinars, or simply give us a call. We can go through that with you as well. So those interest rates, we talked about those before. I showed you the chart. I mentioned monthly, annual, things like that. So how's it going to affect you? We saw those interest rates skyrocket. I mentioned go up about 2.8% so far this year. Now, if you're in a company plan that only updates their interest rates once per year, you're seeing a huge change from 2022 to 2023 as far as your pension lump sum calculation. And so for a lot of you, that means it's if you're thinking about retiring in the next year or two, it became a no-brainer to go now, because when we run the numbers for most of you, if you're thinking about taking the lump sum and not the annuity, which is not going to change, but the lump sum will, you could be giving up, a year and a half, 2 years of salary because of the huge drops in that lump sum. Now, in the quarter by quarter, we've had conversations with you, and we've seen these kind of spike, a percent at a time in different quarters. But what happens is they look at the interest rates on a quarterly average. So you'll see those updated throughout the year. So it might be a 1% change one quarter. It might be, 0.2% the next. And so we look at these for somebody who's close to retirement quarter by quarter and help them determine the best day to retire so they maximize those benefits. But it's going to be less of an immediate swing from update to update than what you'd see in that annual. So it makes planning a little bit harder, but there's still definitely a planning aspect on it. And the hardest one's going to be the monthly rates. In this case, they update the interest rates every month, so it's kind of a rolling monthly average that you're going to see. If you go back to that spreadsheet I showed with all the interest rates, if we were to look at January versus October, we'd say, well, yeah, I want to get out. But if you looked at it month by month by month, you kept seeing it slowly tick up. So it may have been hard to make that decision. But again, we can talk with you when you're close to retirement, give you the forward projections and things like that to help you determine the best day to retire still. But for all the companies we do work with, we do have updates on these on a quarterly or monthly basis or annual basis. So again, reach out to us to get on that email list, and we'll get that over to you. So that's a lot about the pensions. Let's talk about that fourth leg of that stool I mentioned, real estate. Again, this is not going to apply to everybody, but it's something that a lot of people are using now. So it's important to kind of keep that in there. I mentioned, you could have some rental properties that are generating some income. So that's going to be some additional income in retirement. Or it could be that you're in a situation where you may be looking to move or downsize or something like that. We had the real estate crisis in 2007, 2008. Obviously, we're seeing a severe jump in interest rates, which has softened the market right now. And we've seen some reductions in prices and some properties getting stale. But we're not to those levels where we were in 2008. A lot of that's thanks to the supply issue. There was an oversupply before. Now there's a lack of supply at this point in time. But again, we'll see how that kind of goes through. But still, we were having this in here about a year ago where a lot of people could have really taken advantage of the top of the market, if you would, because interest rates were super low. People could afford a bigger house, and that's what drove up a lot of the market. And of course, there's a lot of free money that the government was throwing out there as well. But what's going to happen is, in some cases, you might say, okay, I'm going to downsize. I was talking to somebody just last week that was, wants to get out of their 2-story house, get to a one-bed, not a one-bedroom, but a 1-story house. So that way they can make sure they're better equipped to kind of live out retirement that way. And it was a situation where they were going to probably sell that house for about $600,000, and they were only going to need about $400,000 or so to buy that single story. And it's going to be, newer and better for them, but smaller. So they were able to pocket that 200, or they're going to be able to pocket that $200,000, which can be used toward their retirement goals as well, and can really help in the tax planning structure as well, because that's going to be tax-free money because they lived in there for over 2 years in this situation. So that goes into the plan as well. Other issues are, if you're looking to move from one state to another. We talk about this a lot of times, especially people in the higher tax states, like California, New York, some of the other northern states and things like that, where they may decide to move to Texas, Florida, Tennessee, someplace where there's no state taxes, or maybe just a place where there's lower state taxes. So you may be able to sell a house for something more and go out and buy the same size, or maybe even a bigger house for cheaper and have a different tax situation. So that all comes into play as well. So just be aware if you have questions on real estate and how that kind of correlates into your overall plan. We can work with you on that as well. And one of the biggest ones we've seen obviously this year, and we've talked about it before with the interest rates and the lump sum calculation, is inflation. We've obviously talked about this for the last 2 years, knowing that we're going to see interest rates come up because we were so artificially low with the pandemic. But again, did we think they were going to come up this quick and this high? No. So we've seen a very severe jump in inflationary pressure over this last year or so. But what that means is it's going to affect your, not just your lump sum, it's going to affect your portfolios. And you've seen that happen so far this year, not just on the stock market, but also the bond market, which is really more sensitive to interest rates. So on the stock market, we've seen a pullback because it's just, let's face it, it's harder to come by. The borrowing costs are higher. So obviously it's affected the growth companies that are typically borrowing money to fuel their growth. So as that gets more expensive, it's harder for them to do so. So it's going to cost them more. It's going to slow them down. We tend to focus more on value companies, which tend to have cash on hand and don't need to borrow. So they have not suffered as much. But again, when everything's down, everybody's going to be down in some case or another, unless you just specifically chose, cash and commodities for most of the year. Now, on the bond side, we mentioned those interest rates go up is going to drive down the prices because let's face it, if you bought a bond that was paying you 3% last year, and you want to try and sell that bond, but somebody could go out and get a bond right now for 5%, why would they want to pay you what you bought that 3% for? They're going to pay you a discount. That's what drives down those prices, and we've seen some of the biggest drive downs we've seen in the history since the 30s, really. And once we get to a place where these interest rates level off, we should see a rebound in that side going forward. But again, it's really important to know that how this affects you. Mostly, like I say in your 401k, whether you were all bonds, all stock, 50-50, 60-40, you were likely down. But if you have questions, want to run a review on that and different ways to mitigate some of that risk on both the bond side and the stock side as far as appropriate selection, we can help you with that, let you see what's available in the 401k. Now, it's limited a lot of times. And then also talk about whether or not you have an IRA rollover option, which a lot of companies do give you, where you can diversify a lot more, whether you're working with us or yourself. So the fourth one we want to talk about, so kind of transition into there, working with somebody. It's great to do things on your own. I'm really a do-it-yourselfer, but I do realize sometimes when I've gotten in over my head, I may need to hire somebody. And I'm talking about doing things around the house or building things and stuff like that. But ultimately speaking, if you're not going to do it on your own and you're going to work with a company, make sure you take your time to select that company. Make sure you work with a company that understands you and obviously understands your company plans inside and out. I can't tell you how many times we've worked with individuals who have been working with an advisor for 10, 20, even 30 years and said that they're good and then ultimately took us up on just a review, and we uncovered the fact that, hey, you need to make this change or do this, and it's going to save you or make you $30,000 more in your transition. They still work with the advisor, or they've maybe worked with us for a portion, but at least we're going to help you determine the best day to retire. And then from that point, if you are working with somebody, make sure you understand their fee structure. Obviously, we're going to charge a fee. We have to make a living. But everybody's going to charge you a fee in one way or another. I can't tell you how many times I've sat down with somebody who said, no, I'm not getting charged a fee. And we've asked for the statement, and we pinpointed where those fees were getting charged, and they didn't know that. In some cases, you want to make sure at least you're getting what you're paying for out of that fee. At the Retirement Group, we're an independent firm. We're not a cookie cutter firm where we put everybody into the same portfolio. Our goal, like I said before, is to back into what you need to achieve and do so with as little risk as possible. And then we'll present to you multiple choices as far as different ways to do that. And as a fiduciary, it's our responsibility to be on your side of the table every step of the way, not just at the first meeting or when you decide to make an investment allocation. And then figure out what it is you are looking for, whether you want to focus heavy on taxes, a web service, whatever it may be. Just let us know what you're looking to focus on, and we'll make sure to add some additional focus to that. And at the end of the day, you need to work with a team. Myself, the other advisors here, we can't do absolutely everything. We need to rely on the retirement group's back office support, the investment management team to help with some of the investment decisions, and we also rely on the support from Schwab, who we clear through. So if you were to work with us, we'd be looking at opening up a Charles Schwab IRA where you can roll that 401k over to and help you get that more diversification selection than what you have in your 401k usually. And at the end of the day, you need to run that cash flow analysis I mentioned. If you don't do that, I don't know how anybody can really give you a true recommendation. You need to know what you're trying to solve for before you can give an investment recommendation. So take us up on that. It could take as little as 5 to 10 minutes to gather the data for you. And then we'll give us about a week. We'll get that put together and set some time to sit down and go through that and then make any updates you want to do. But this will give you a better idea of where you stand and help you determine the best day to retire and the best selection process on your pension choices we talked about earlier. But right now, about 3/4 Americans over 50 don't even have a written plan. And like I said, just spend a little bit of time with us. We can get that together for you and then dig as deep as you want to and make as many changes as you want to. So with that, I'm going to wrap it up and then see some of these questions that came in. But if you have any questions that you want to get to us, just go ahead and reach us at info@theretirementgroup.com, or you can call us at 1-800-900-5867. We've also got a couple QR codes up here if you want to follow along. Hold your camera up to that. I'll keep this up while I go through the questions, but you can schedule an appointment with myself or one of the other advisors. Or you can also follow us on our LinkedIn page and get into the company-specific page so you have updates on your company plans, whether it be the interest rates I talked about, how those are changing, any company updates or changes to the 401k, pension, healthcare, things like that. We'll get all that information up for you as well so you can follow along. So let me go and get over some of the questions that did come through here. First one, my company offers me a lump sum as I am a legacy employee. As legacy, I have a lump sum option. Why do interest rates affect me? Okay, so I kind of went through this earlier as far as the way that the lump sum options work, and this is for legacy. So that cash balance plan I didn't go into, but the cash balance plan, it essentially is a lump sum. It's portable. It's going to stay with you. So when they put that in, let's say you're getting $10,000 contributions a year, and let's just assume a flat market or a flat interest rate, but so that's $100,000 or so after 10 years. If you retire or you separate, that's your $100,000 to take with you. That's essentially a lump sum. But the lump sum this person is talking about for legacy employees that have been there longer are going to be on the defined benefit plan where they run that calculation I mentioned, looking at the years of service, final average pay, multiplier and stuff to give you an annuity. So when you have that annuity, in order to turn that into a lump sum, if the company allows it, not every company does allow it, but to turn that into a lump sum, that's where the interest rates affect you. They have to use the interest rates for that month, that quarter, that year to calculate out what your lump sum is going to be. So when those interest rates are higher, like we said, the lump sum is going to be lower. When interest rates are lower, the lump sum is going to be higher. So that lump sum will fluctuate. The annuity will continue to grow, but the lump sum will fluctuate based upon those interest rates, and that's why it's going to affect you. But if you have questions on it, give us a call, and we can kind of go through your specific situation, like I said, and show you based upon your company how it's going to update either monthly or quarterly or once a year. Is my pension adjusted for inflation? No, probably not in the way that you're asking that. No, inflation does not get adjusted into your pension unless you factor in while you're still working. Obviously, as you make more income, it's going to factor in that calculation. That's one way I guess you could look at it. But no, the pensions, if you get that annuity, there's not a cost limit adjustment like you see in Social Security. So if you get $2,000 a month for the rest of your life, it's going to be the same $2,000 now as it's going to be 10, 20, 30 years down the road. So obviously your purchasing power is going to erode over time. That $2,000 is only going to buy half of what it bought in probably 20 years or so. Or if we stay with this inflationary pressure we're at right now, it could be quicker than that. So inflation is not built in there. Now, that's where a lot of times people will look at the lump sum because you have the option to invest that and generate potentially more than what that annuity is going to provide and more flexibility there as well. So if you want to get into those pros and cons, give us a call. We can go through that with you as well. Is my pension just to that. If I buy an annuity with my lump sum, is that better than taking the company annuity? That's all going to depend on timing. Usually the answer to this would have been a flat out no. You're going to be better off taking the company pension annuity versus buying your own annuity. And that's just because where interest rates have been for the last couple years or so. But we're in a unique environment right now where, especially if you're on that annual or even quarter interest rate calculation method, where you still have a pretty high lump sum. But what's happened is the interest rates have come up, which have increased the annuity payments on private annuities. Whether you go out there and let's say use Nationwide, Prudential, Fidelity, whoever it may be, to give you a guaranteed income for the rest of your life. The same thing, comparing apples to apples, is what your company would do. You can go out there and say, okay, let me take this lump sum and see if I can buy my own. And right now, we've been doing that with a lot of people, where they've been able to increase their monthly payment by $300 to $1,000 a month more by doing that on an apples to apples comparison. Now you can also go in there and say, okay, well, maybe it only takes me 85% of my lump sum to match the annuity, so I can do that and keep 15%, or maybe I split it 50-50 so I have more flexibility for my income and my growth. There's a lot of different things to do there. And there's also options where you can, add a cash refund. So make sure you get your money out if you pass away too early, your family gets it, or a period certain. And a lot of those numbers are coming out better as well. Now, fast forward, as time goes on, these interest rates continue to go up. That's going to equalize itself. What may not be as beneficial in the next year or so, but we need to really look at it on a one-on-one cases, because it depends upon how old you are and when you're retiring. But we can run those numbers and show you, okay, here's what your annuity pays. Here's what your lump sum, if you turned it into your own annuity, would pay. And here's what your lump sum could do over time. We can show you those for that cash flow analysis. So you have all those choices as you transition into retirement. Okay, so why do some employees at my company have a lump sum and others do not? Well, we're talking to a lot of companies here on this webinar, so I really can't go into each company by company specific, but we talked about before, even in some companies, depending upon where you were hired or whether you're at a different firm that got acquired, you're going to have different pension plans. So usually for those that are newer employees, that's where they're going to be on that cash balance plan. They'll still have that lump sum, but they're not going to have it as high as what somebody who's a legacy employee who would have had the defined benefit plan calculation model that was converted to a lump sum. And then there's also the case where some companies transitioned where they said, okay, we're going to allow that lump sum option, but let's say starting in 2010, I'm making something up, but we're gonna grandfather those employees. We're not gonna change that plan, but going forward, everybody's just gonna have the annuity option. So again, it's gonna depend upon where and when you were hired. Now, if you have questions specifically, give us a call. We can show you or tell you based upon your company, and actually help you run an estimate to show you that difference there as well. Now, let me do one more, then we'll kind of wrap this up. Is my lump sum taxed differently than the annuity? Yes and no in this case. So it all depends upon what you're doing with it. So I'll go back to that $2,500 example I gave you before. If you're getting $2,500 a month for the rest of your life in annuity, that's going to be taxable income. So every month that comes out, it's going to be taxed, whether you pay the tax on your own or get a withholding, that's up to you, but it is taxable income. Now, if you took that lump sum, let's just say it's $500,000 for example, and you move that over to an IRA, that's not a taxable distribution, that's a rollover. So it's just a transfer of assets. You're not taxed until you physically take that money out. Now, if you were to start taking $2,500 a month from that account, then yeah, I guess they're taxed the same way. But if you allow that to defer or you take it out at different times, it's only taxed when you take it out. So there's no difference as far as the amount you'd pay in taxes. It's just a matter of when you take it. One caveat to that would be is, let's say if you go back to that person that was 57, I made a mention of before. If you retired at 57 and took the annuity, then you're going to pay tax on there, but no 10% penalty. If you took the lump sum, moved it to an IRA, and you took a withdrawal before 59.5, there'd be a 10% penalty on that unless you got around that through a 72T, which we can go over with you as well. So there is a little bit of different potential tax treatment depending upon your age. But I hope that kind of helped everybody with a lot of the different information. But ultimately, like I said before, the best way to run your information is to give us a call or schedule an appointment. Again, you can reach that 1-800-900-5867. And a quick reminder, even though we've worked with a lot of your companies for quite a long time, that does not mean we're employed by them, nor are we endorsed by them. However, if you have any questions, just call us and we can run through the situation for you and show you exactly where you stand and the different choices and options you have as you transition to retirement and how to maximize those benefits with your company. I want to thank everybody, and we hope you have a great day.